Do you have bad credit? Maybe you're just starting out and you have no credit. Unfortunately, your credit journey is with you your entire life. Decisions that you make today can impact you for years down the road. In this video, I'm going to explain what a credit score is, what the parts of it are, some tips to raise your score, and some things to avoid doing. If you haven't done so already, please subscribe to the channel, give me a thumbs up, and let's get into the video. Before I get into what a credit score is, I had the privilege of interviewing Eric Vallada, a credit repair specialist, in this video right here. When you get a chance, go ahead and watch it. He's not only been doing credit repair for years, he also trains others on how to start their own credit repair business, and has also co-authored a book, The Credit Files, which I'll link in the description below. So what is your credit score? A credit score is a 3-digit number, usually on a scale of 300 to 850, that estimates how likely you are to repay borrowed money or pay your bills. Credit scores are calculated from information from your credit accounts. That data is gathered by the credit bureaus and compiled into your credit report. The 3 largest bureaus are Equifax, Experian, and TransUnion. Lenders will set their own standards for what scores they'll accept, but here are some general guidelines. A score of 720 or higher is generally considered excellent credit. A score between 690 and 719 is considered good credit. A score between 630 and 689 is considered fair credit. And scores of 620 and below is considered poor credit. A higher score increases the lender's confidence that you'll make payments on time and may help you qualify for lower interest and fees. Also, some lenders will lower their down payment requirements if you have a higher credit score. On the other hand, a low credit score can make it harder for you to get a loan or a credit card, and your interest rates may be higher. Your credit score is based on the following 5 factors. Payment history accounts for 35% of your score. This shows whether you make a payment on time, how often you miss payments, how many days past the due date you pay your bills, and how recently payments have been missed. Payments made over 30 days late typically will be reported by your lender and hurt your credit score. How far behind you are on a bill payment, the number of accounts that show late payments, and whether you've brought all your accounts current are all factors in your score. The higher your portion of on-time payments, the higher your score will be. Every time you miss a payment and it's reported to the bureaus, it will impact your score. The next portion of your score is the amount that you owe. How much you owe on loans and credit cards make up 30% of your score. This is based on the entire amount that you owe, the number and types of accounts that you have, and portions of money that you owe compared to the amount of credit you have available. High balances and maxed out credit cards will lower your credit score, but lower balances can raise it if you pay on time. New loans with little payment history can temporarily drop your score, but loans that are closer to being paid off could raise your score because they should show a successful payment history. Next up is your credit history, which accounts for 15% of your score. The longer your history of making timely payments, the higher your score will be. Credit scoring models generally look at the average age of your credit when factoring in credit history. This is why you should consider keeping your accounts open and active. It may seem wise to avoid applying for credit and carrying debt, but it can hurt your score if lenders don't have any credit history to review. The types of accounts you have make up 10% of your score. Having a mix of accounts, including installment loans, home loans, retail and credit cards will help improve your score. Recent credit activity makes up the final 10% of your score. If you've opened up a lot of accounts recently, or applied to open up accounts, it may suggest potential financial troubles and may lower your score. However, credit scoring models are built to recognize that consumers who are shopping for a loan aren't extra risky. So how can you fix your score? The first step to fixing your credit is knowing what your credit score is. Get a copy of your credit report. There are several free credit report sites out there, such as annualcreditreport.com, Credit Sesame, CreditWise, and Credit Karma. Depending on what credit cards you have, they may also provide a free credit report for you. Many of the reports generated from these sites and cards will actually have a breakdown of what's impacting your score. This is actually helpful for you because it gives you a place to start. I'll go over some general steps for boosting your score. Everybody's situation is different, so do what's best for you. Tip number 1. Remember that credit utilization is 30% of your FICO score, and that's a pretty big chunk of the pie. If your credit cards are all maxed out or close to it, that will have a major impact on your score. If this is your current situation, you need to get a plan together to correct this. Remember, the credit score journey isn't a sprint, it's a marathon, since your credit score will follow you all of your life. So if you're currently at 90% utilization, put a plan together to get you to 75% utilization. Once you get there, work to 50 and 30 and so forth. Less than 30% is good, but remember that less than 10% is better. Tip number 2. This next tip can be a double-edged sword, so be careful with it. If you've been paying on time and have a good history with your credit cards, you can call them and ask for a credit limit increase. Now, why would you do that? This is a quick way to lower your credit utilization. If you currently have a $2,500 credit limit on your credit card and your balance is $1,500, This would be a 60% credit utilization. If you were able to call and get your limit increased to $4,000, your utilization would go down to 37.5%. Again, be careful here. You need to stay fiscally responsible and not charge up your cards because the money's available. Also keep in mind that some credit issuers do a hard credit check when you request a credit limit increase, and that could cause your credit to dip. Tip number 3, consolidate all your debt into one payment. Remember, there are different types of credit, and this is taken into account for your credit score. Credit card interest rates are usually your highest interest rates. If you have 5 cards with an average interest rate of 25% and are able to get a consolidated loan for a lower percent, this can help save you on interest payments. It'll also add a new loan type to your credit history that accounts for 10% of your score. Again, the key here is staying fiscally responsible. If you take a loan out and pay off all your cards, please don't run out and charge them all back up again. You'll be in a worse situation than where you started. Tip number 4, become an authorized user on someone else's account. If you're new to credit and you can't qualify for credit on your own, becoming an authorized user on someone else's account is a great way to start. But it's another double-edged sword. If the person who owns the account has healthy credit, it can help you establish a positive credit history over the long run. On the other hand, if they have a poor credit history, that can also reflect poorly on you. That's why it's important to pick someone that you trust, who has a long credit history and a higher credit score than you. Tip number 5, set up auto payment for all your credit cards. This will help you develop a consistent payment history over time. It may not help raise your credit score fast, but it will protect you from dropping it fast. We're all busy, life comes at you fast. It's easy to forget or miss a payment. Setting up the minimum payment will hedge you against a late payment. If you did forget, you can always go back and add an additional payment to pay down the balance. But the important part here is that you don't get dinged for a late payment. Tip number 6, find out when your loans or your cards actually report and make sure you pay your balance before that date. Call your credit card issuer and ask when your balance gets reported to the credit bureaus. That date is often the closing date or the last day of the billing cycle. Note, this is different than the due date on your statement. So here's the problem. Even if you pay your balance off every month, and you should, if your payment is received after the reporting date, your reported balances could be high, and that negatively impacts your score because your ratio appears inflated. So pay your bills before the closing date. That way your reported balance will be low or even 0. This lowers your utilization ratio and boosts your credit score. Tip number 7, get errors taken off your credit report by disputing them. Sometimes banks make reporting errors that hurt your credit score. Even if you haven't missed a payment, many consumers overlook the benefits of a periodic credit report review. If you find an error, you'll need to file a dispute with the credit bureau. No error is too small to dispute. To dispute credit report errors, send a letter to the credit bureau that generated the report with the inaccuracy and explaining why it's an error. The bureau generally has 35 days to investigate and respond. For those of you trying to fix bad credit, this may get you the biggest increases the fastest. Here are a few don'ts to keep in mind. Don't apply for a bunch of new credit cards just to increase your credit utilization. Even though this might lower your credit utilization ratio, it could also make you look like a risky borrower thanks to the new hard inquiries on your report. For the same reason, don't go take out a new loan to improve your credit mix. Only apply for a new loan if you actually need it. Don't carry a balance on your credit cards just to build credit. Carrying a balance on a credit card can lead to unnecessary interest charges. It might actually keep your score down by increasing your credit utilization ratio. Don't cancel your credit cards after you pay them off, unless you have a good reason to do so. Closing older credit cards will hurt your length of credit history, so in many instances it might be better to leave them open. I hope you found this video helpful. Remember, the credit score journey is a marathon, not a sprint. Work on it every month as best you can, and if you need help, there are credit repair specialists out there that can help you. If you haven't done so already, subscribe to my channel, give this video a thumbs up, and I'll see you in the next video.